Hello and good morning, listeners. This is Almus Market Mornings with Shikhar Garg, and we have light and overcast, both weather-wise and concern-wise, in the financial markets. The Credit Suisse story had few twists in the store unraveling yesterday. SNB released a statement which mentions that FINMA is confirming Credit Suisse having necessary high capital and liquidity requirements, although this was the biggest concern with respect to the defaulting of the Credit Suisse actions. And yes, on the other hand, the Credit Suisse is also seen intending to exercise their options of borrowing from the Swiss National Bank up to 50 billion Swissy to meet the capital requirements. So in a way, there exists an option of backstop by the Swiss National Bank. But more detail in this story by JK, I'd like to hear from you. But other updates, if we have to talk about, US retail sales continues to slow along with the lower trade deficit for the Indian nation. I mean, both export and imports saw a drop overall numbers, but the net trade deficit was on the lower side for the second straight month. So, JK, what are your thoughts? What's going on in the markets and how to manage the risk?
Hey, good morning. After lull on Tuesday, it was another turbulent day in financial markets yesterday. And this time it was Credit Suisse in the limelight for wrong reasons. Credit Suisse was always on the radar of the credit markets because their CDS had been very often soaring, and people were concerned about the health of the bank. And the latest banking crisis in the US has only aggravated the situation there, and it was therefore not a surprise that it led to the market turbulence yesterday. At one point of time, the bank's share was down 30%. Later, it recovered. Now, the morning news says that they are accessing a credit line of 50 billion Swiss franc from the central bank. Well, that addresses probably the immediate liquidity issue and possibly some capital, but it doesn't take away the fact that due to the low yielding asset portfolio, their profitability is not going to improve in any manner of that will be impressive. Therefore, markets had very short-lived positive reaction. They're again slipping back. Concerns are remaining about more institutions which may come under the attack from the speculators as well as the investors. Now, the significance of Credit Suisse issue was much more reflected in European yields and the euro, which dropped massively, single currency dropping 2%, and Germany shedding nearly 40 basis points. And the European equities were more than 3% lower, carrying it over to the other markets. US markets also fell more than 2% at one point of time, but recovered later to end only 1%. Nasdaq, of course, performed better because of massive drop in yields and expectations that rate hikes may be nearing a top helped it. The KBS banking index declined by 1.5%. Now, rating agency S&P downgraded the First Republic Bank and gave a lot of negative comments about its health, and which added to the negative sentiment. So, in a constantly changing environment, we did have the Swiss Bank news, Swiss Bank's news in the morning, but Asian markets slightly recovered after that, and they have somewhat maintained that recovery, but it's all very tentative, of course. Now, the biggest question in the minds of investors is: are we headed for a much larger financial crisis like 2008, which has no immediate answers? Hence, markets will remain volatile and risk-averse. If things can be improved, it requires a strong action from central banks and the government, the shape of which should be clear in the coming days and weeks. In my view, governments will have to loosen their fiscal further, and central banks may give inflation secondary importance for now and hope that the current turmoil will result in higher unemployment and lower demand, leading to price pressures eventually dropping and not having to raise the rates further. So the focus is on what the central banks are going to do. First of such evidence will be when ECB meets today. Markets are pricing in a 60% chance of a 25 basis points hike by ECB today, compared to 90% chance of a 50 basis hike just 2 days back. Now, Fed futures are showing that the December contract tumbled to 3.767% from over 5% a week ago. So that's the year-end rate cut which they're pricing in now, and the first of such rate cuts are being expected in June itself. Yes, definitely, if the turmoil continues, we will have central banks acting faster than what is being expected now. The yields have been all over the place, and 40 basis points recovery on Tuesday by two-year yields in the US have been followed by a drop to a fresh low of 3.82%. And that's a massive 125 basis points. That is 1.25% drop from its high of 5.08 just seen a week ago. Now, amid all this turmoil, the economic data took a backseat. Retail sales fell moderately by 0.4% versus 0.3% expected. And retail sales are actually not adjusted for inflation. Therefore, this might be reflecting higher prices paid for the goods as well. So the actual drop can be in terms of value goods, it may be actually much lesser. Also on the news, Empire State Manufacturing dropped to a new low of 24.6 versus -8 expected. News and inflation was somewhat encouraging. The PPI slipped to 0.1% in February, and January was also revised down to show 0.3% positive versus 0.7% previously reported. Year on year, it increased to 4.6%. That was the smallest annual gain since March 2021, followed by 5.7% in January. Today morning, Australia also announced their employment data, which was much stronger than expected. Aussie has been holding up above 0.66, supported by these recent set of good data. But everything is overshadowed by the turmoil in the banking sector. Now, same is the case with India. The trade balance improving once again, and showing at 17.43 billion from 17.75 billion. And this is a second successive month of a big drop in the deficit. It really augurs well to contain the current account deficit much below what was projected earlier for the year. Now it is around 80 to 85 billion compared to 130 billion CAD that was anticipated way back in September, and BOP is now possibly below 15 billion for the year versus 50 BO. That is 50 billion expected earlier. So meaningful shifts have happened in India's services exports. On a net basis, services exports are raking in 60 billion per year more in revenues than in the pre-pandemic period, cushioning the impact of the big rise in nearly 90 billion in the merchandise deficits. So though these numbers were released during the trading hours, impact on the same was limited because market was completely immersed in the global turmoil, and dollar demand continued on even minor dips. And yesterday we did hear quite a bit of selling by the PSU banks, but the demand was so high that as soon as they were off with the banking hours closing, rupee was trading well above 18.80, and even now it's showing that rate. I think it's some more time before India's domestic improved fundamentals will reflect in the rupee, because even the oil price, which is now trading at 74, that is Brent, is a good augurs well for the Indian economy. But really, it's down to when we will see the end of this current global turmoil. Now, finally, some analysis that how all these things will pan out as a recession, because now the steepness of the yield curve is definitely corrected. It's much, I mean, the inversion of the yield curve has improved much better. But according to analysts, it's when it starts to steepen that is when the recession is actually will be seen. And what would probably trigger the recession is that the financial conditions are going to tighten. Banks are going to start tightening their lending norms even more, and that will be a trigger for a slowdown in the economic environment, economic activity, and also investments, and so eventually leading to lesser employment or higher unemployment and lower demand for goods and services, which is the ideal path that the US Fed will be hoping for. But let's wait and see how it pans out. Thank you.
Okay, JK, and I totally agree. I mean, going historically, if we see any of the crises, a good tightening cycle always was succeeded by some bit of stress in the jobs or the labor market, and that is one of the key areas I think even the central banks are looking forward for to take any sort of action when it comes to rate cuts and actions on the pausing of the rate hikes. Even the Fed, for that matter, may be looking forward for a cooling of the jobs market before they can actually go ahead with the expected rate cuts as the market participants have been talking about. But yes, there has been a meaningful change with respect to the services sector in the Indian markets, and a 60 billion rise in the services exports. That's quite a significant number, bringing in support for the overall trade deficit and the balance of payments for the Indian economy. Oil prices, on the other hand, are also still supporting. But what is another key thing that we'll be watching out for is the ECB's actions on the rate front. We have the ECB meeting today, and hike or a pause or any further commentary by the central bank will set up the tone for the currency in the coming days. So yes, the overall banking crisis is aggravating concerns on the health of many of the banks across, but it still remains an interesting and uncertain period for the financial markets. We shall come back again with another round of updates. Thank you so much for listening today.